if you have 200 Taco Bells, it means the deal is like $500 million on the debt. Over the course of a year there, literally met thousands of founders, funded probably at least 1,000 brands. The retailer never cancels. Like, I cancel because I don't have enough inventory to fulfill it. Do I raise equity to fund this inventory? Do I say no to this massive deal? You don't have to dilute yourself with equity. You don't have to say no to this deal. We have, $45 million in originations right now in just kind of 6 months. There's a lot of fintechs out there that are just like technology-enabled financial companies. They're not financial technology companies. Banks need assets, and most of these brands, like, inventory is the only asset they have. Let us put in the inventory, and then we'll just wait around to get repaid. I started off in like restaurants and like very big restaurant deals, like Five Guys, Raising Cane's, like 200 unit Taco Bells, which if you have 200 Taco Bells means the deal is like $500 million on the debt side. And then from there, joined the Peace Corps to do economic development work overseas. So I was actually in Colombia teaching entrepreneurship and financial education. I was planning on going a traditional consulting route. Keep my options open. I was at BCG for the summer, but that's when Wayflyer reached out to me, and it was a great, if recruiters take note on how to message someone. Because I was like, my internship at Warren at BCG, it was like what you're there to do in the first place. And they're like, record-setting European fintech Series A is looking to make you their first hire in the US. And I'm like, that's a good sell. I'll take this call.
How can you say no to that?
Exactly. I was like, I like records and I like being the first. Now, to be fair, I was the first credit hire, but like not the first hire, but I'll take it. And so met with the team, was really impressed by what they were, building and doing at Wayflyer, which was entirely at that point focused on the e-com side of things. And they had a super young, super smart squad, and just like fantastic energy of people who were like out there grinding and working hard, and also kind of like inventing a space at the same time on the e-com side. And so you talked earlier about your second university degree. Like to me, Wayflyer was its own university. Even with a little study abroad, because I spent like as a month combined in Dublin across a couple of different trips with the team. And so it's really like got some of the lingo down, like the craft with the lads, and it's all good fun. And then from like the university experience side too, they became a unicorn while I was working for them. So I dropped out of Wharton, and I'm still on a leave of absence technically. That is unlikely to ever be resolved. And then in true startup experience, get hired. We work in the US with Wayflyer. We opened a big Atlanta office, become a unicorn, and then they realized they scaled too quickly, and then laid off like the whole American squad they hired and closed the Atlanta office. So just truly full circle experience, where I then briefly, it was kind of over a bit like the consumer brand space, and went to a seed stage real estate fintech called Nectar that focuses on like Airbnb and small apartment building financing. Did that for around a year and a half, like kind of digital nomading around the world at the same time. And it was a great experience. And that's when Highbeam reached out to me to be their first head of credit. They had a debt facility that was requiring, it was a $100 million debt facility. They were like, you need to hire a head of credit to manage it, or else for, closing condition. So they reached out. And so just massive growth there. As like larger and larger brands kept signing up and using it. I realized I was saying no to a lot of deals, which did have some advantages for what we were doing at Highbeam, which is that, I had been at Wayflyer. I knew how Clearco and a lot of these other lenders worked, or the ABLs, SG Credit, Assembled Brands, and like Highbeam is a great platform to do it on. So then it really helps to kind of broaden out my ecosystem and how I was viewing things. And then that's when I met my co-founders at Springcast, Tage and Oliver. Tage has a VC background, Oliver was a prop trader, and they were looking for someone who had the consumer brand experience as well as the lending experience to round out the founding trio to start, the consumer brand lending fintech. And one thing I didn't mention about my time at Wayflyer was I got randomly assigned to like a thought project on understanding CPG brands better, because Wayflyer originally only funded e-com sales. And so we'd be with a brand that's like, hey, it's great that you're doing our e-com funding, but e-com is only 50% of the business. What about this Target order? What about this Walmart order? And we came in with the assumption, we're like, oh, for sure these retailers cancel on these brands because they have this power, and like they're just going to bully these small guys. But then I spoke to like 100 CPG brands, probably more, and they were all like, oh, like the retailer never cancels. Like I cancel because I don't have enough inventory to fulfill it. It was like the most shocking, from like outsider perspective thing you wouldn't expect. But like honestly, it was always these brands that just couldn't have the capital to do it. And so then, what Wayflyer created was a bit like a square peg in a round hole, where they would help fund this retail channel growth, but with daily, weekly, bi-weekly repayments, which isn't actually matching the cash conversion cycle that you have when you have these invoices from Walmart, who's gonna you pay now, you deliver it 30 days from now, right? They pay you net 60, net 30. And so, we realized at Spring that that's like the gap that we could really solve. And by doing it on a system that's truly automated and not automated with like a team of wills behind it, but like automated like properly with technology, then we can move quickly, work with smaller brands that other traditional lenders don't want to touch, and really open up the market. I see in emails from our portfolio manager send it to these brands like, "Hey, Costco paid us $200,000 today. Target paid us 150. Your balance is now, if your balance is zero, we remitted you the delta." And so it really makes it a much cleaner, simpler process. And allows us to have, we have, $45 million in originations right now, and just, which I think is higher than, obviously higher than the last time we spoke, Connor. And really kind of 6 months since our first loan, and the outstanding book on that's probably around like, 25, with like, no losses. And like, if you want to call it like a delinquency is less than 0.1, 0.2%. And it's really because of the structure we set up. And what I love about it is I think it really does kind of solve these brands' problems, because if they're growing, then they're stuck in this tough spot of like, do I raise equity to fund this inventory? Do I say no to this massive deal? And it's like, well, you don't have to dilute yourself with equity. You don't have to say no to this deal. Let us fund the inventory, and then we'll just wait around and get repaid. That's kind of like the beauty of we're doing Spring, and by being really tech forward and focused about it. It really allows us to grow quickly, and not good for my sleep, but good for everything else on our end.
Yes, I think I remember when we first caught up, I feel like you were damn near sleeping in the office. And I think, I went from the space of kind of seeing Spring Cash here and there, and then it's literally everywhere. Like, it couldn't escape Spring. It's all in my kind of the newsletters and LinkedIn feeds, and all the different brands that I've worked with or want to work with are kind of shouting you guys out. So it feels like it was, obviously it's never kind of 0 to 100, but kind of the foundation that you laid throughout kind of Wayflyer, Highbeam, and then coming back around to Spring Cash, I guess created a pretty good platform for you to kind of, I guess, accelerate pretty quickly and bring on new brands.
Yeah, and especially too, like on the engineering side, like, Oliver is a former prop trader, and I've worked with a lot of great engineers, across the different companies I've been at. But his ability to like, and our other engineer Lucas, their ability to like update things is incredible. Like, I was on a call with the brand who was looking at their dashboard and was like, "Hey, this dashboard would be a lot more helpful if you had the invoice number for this payment from Target here, so I knew exactly what it tied to." I was like, "Okay, yeah, I'll let our engineering team know." They're pretty quick, maybe like in a week or so. Don't want to make any promises. And then I go to lunch, and I look back at Slack, already updated, within 2 hours. And I'm like, "This is live?" He's like, "Yes." So I emailed back to the brand. I was like, "Told you it'd be quick. I didn't think it'd be this quick." And so just like truly being tech focused has helped us take off. And it's something that, when I joined Highbeam, I listened to a bunch of podcasts with the co-founder and CEO. And one of them that really stuck out to me was like, there's a lot of fintechs out there that are just like technology enabled financial companies.
Mm-hmm.
They're not financial technology companies. And I feel like if you look across the space, that really is the case for a lot of these, where if you dig under the hood of how some of these fintechs operate, you're like, this is very much an old school manual thing that has a little bit of lipstick on it. And I think by being really focused on that, like building out great tech, it's enabled us to automate things where, I spent most of my time meeting brands, meeting consumer investors, meeting other partners, because, we built our underwriting out that we have like a overarching model that we tweak and adjust and this and that. But it does not require me to write memos or review memos on all these companies, because it's like we have these strict rules that we're following. And at the end of the day, our counterparty is Costco, Target, Walmart, etc. And that also makes it a lot easier. You have like a public counterparty paying you, and not, a small company.
It's harder for a Costco to default, right?
Yeah, it is harder, but not, obviously it was a GNC went bankrupt a couple of years ago. So there's always,
It does happen.
and then Saks, right, recently. It does happen. That's what credit risk insurance is for.
True, very true. And I'm sure, well covered in all fronts in that regard. So it sounds like, I guess, a lot of the brands that you work with are maybe not the ones doing, call it $100 million, $200 million a year, but it is kind of those in those rapid growth stages. First, I guess, kind of sinking their teeth into retail, whether it's first launches, second, third, and you're really kind of helping them to achieve scale before, I guess, see that cash flow and consistent injection coming in from these launches. Is there like a certain bracket of brands you work with, or it's open-ended, but you guys can move quickly and support the smaller brands? Like, who's in that ICP?
Yeah, I mean, so I see our true ICP that we really love to work with is probably like the called 3 million to 30 million range, where like right now our maximum deal size is capped at 3 million. And so from like the cash they're looking for, it's a really good fit. But we are able to work with brands as small as like 250,000 in annual revenue. We just have like a little
Wow.
tighter box around their liquidity and their cash. Because at the end of the day, like even if you're only doing 300,000, like if you have some cash in the bank and we know it's actually target paying us, like okay, well, like roll the dice here and be maybe a little more conservative on like the advance rate or the cost of capital. But the thing that I think surprises some people is whether you're a brand doing 3 million a year or 24 million or 50 million, like you get hit with these massive orders from these retailers that you have to like you don't have this cash lying around. Like we did three Costco deals and pretty much the last month for brands. One was 10 million a year in revenue, one was 24, one was 50, and that 50 one's probably on track to be nine figures by the end of next year. They just got hit with these massive orders that were like, we need something to help plug this. And it's like, okay, here, we'll give you 3 million to pay your suppliers. And that 3 million of inventory is worth, $5 million to Costco and Walmart and whomever. And then boom, we've like plugged that gap. But it's really one that you people, I think when I speak with smaller brands, they're like, oh, like if I don't work with you now and I'm doing 750, once I hit 3 million, I'll be with a bank. And it's like actually like a bank is still not going to lend to you. Probably not going to lend to you when you're 50 million either. Like banks are they need assets. And most of these brands, like inventory is the only asset they have. They don't have like equipment or like the only ones that really have bank loans are the SBA are generally people who build their own manufacturing facilities. Works out for some of them. It's definitely a bit more capital intensive bet where I don't know if I would make my own facility unless you're like really confident in what you're doing.
I think that's really interesting, and I think you've touched on a really like a couple of really core points that brands go through in terms of trying to find capital. And I just think about my journey right now in terms of Morning Made and then the range or the size that we're in. We're very much in that bucket, and very much can relate to that cash conversion cycle being retail first. So I think about 75% of our business is large retailers. And I think the challenge is we work with companies like Wayflyer, which is exactly what you mentioned before, where we have a facility set up with them. We get paid, we get allocated that amount and then we repay that every month, but it doesn't necessarily tie back to our true cash conversion cycle, which is laying upfront money for a very, very large PO and then 120 days later being paid by Walmart. But what people don't probably get as well is that's only a portion of that PO because you've probably tried to plan for, 3 months of inventory potentially. So some of those reorders as well.
Yeah.
I guess what are the key things that you look for when working with a company like Morning Made? I guess when we will go to a bank, exactly like you said, they're looking at revenue, growth, net assets, profit, these types of metrics to define, okay, what is your sort of borrowing capacity essentially with a bank? Is it purely just looking at the PO and invoice essentially that Target would place? What are some of the other factors that you look at?
Yeah, I think for us, what was kind of an interesting kind of development over time with our risk rating was, right. I came from a bank background. We love financial statements. As a bank, you actually never really looked at the bank. You didn't look at the cash or like I'm looking at the financial metrics that are audited or have real accountants preparing it. And then at Wayflyer, above a certain deal size, it was a lot of like financial statement analysis versus like obviously you're still looking at the bank and all the Shopify and other ads, but kind of move towards that lens. And the beginning as we were developing Spring Cash's underwriting model, we're trying to blend kind of all the worlds we had seen and make it best. But what we realized, especially working with these smaller brands, is that the accounting is wrong 90% of the time. And so it eventually led us to just like basically ignoring the financial statements. You could say like we still have them connect via Codat, which is an automated API, kind of like Plaid. And what it's really useful for is verifying, if somebody connects their bank and the bank is showing 1 million in revenue in our system, but like the Codat saying 5 million, then it's like, oh, wait a minute, maybe we should fly like either reread something wrong or missing a bank account. So it like serves as like a helpful like sense check that you're like properly responding to people. Cause there are some brands who like, yeah, shows up even less than that. It's like, oh, they don't qualify. They're 200,000. And it's like, oh, well, we didn't connect this bank account, but we saw they had 10 million in revenue because of this accounting connection. But we eventually just stopped using it for the underwriting and just really focused on the bank. Because at the end of the day, our philosophy was like the cash is king and it doesn't lie. Like if you're profitable, you're gonna see that cash coming out and it's either right, you see it go back into inventory or other pieces or go to distributions. and like you're not repaid by equity on the balance sheet or net income on the right. You're repaid by cash, and so it was kind of weird to me to actually embrace doing, but it helps us save a lot of time and actually automate because then you don't need to have somebody go in and be like, oh, like this Wayflyer loan is listed as a long-term debt, but it's obviously a short-term debt, and redo all this jiggering. It's just like you already see all this stuff in the bank data, and so we take a really good close look at that, and a lot of what we're looking at is like kind of liquidity and cash trends. Like, are you doing 5 million a year in revenue, and your bank balance is 5K and it dips to 1K, constantly? Or are you average? Is it 100,000 in the bank today, and you're averaging 200 and you're pretty stable? Like, it's honestly surprising sometimes these large brands you meet and like how they have like no cash in the bank, which obviously it creates opportunity for us, but made us like in terms of advising our risk rating system just very cash focused because of how much variation that people have. And then we tie that then to, okay, like we look at the cash is truly our risk rating on the brand and the trends over time in the bank statements and transactions. And then who's the counterparty? Is this a Costco PO? Is this a Walmart PO? Is this a random distributor you never heard of? Right. And so with these random distributors, which is more of a thing with like beverage brands or alcohol brands, like less likely maybe to do the PO finance and just do like the invoice factoring. But we will like diligence all these other providers. But then at the end of the day, that's kind of the beauty of it is like we get comfortable on the bank side and obviously do our KYB, KYC. And then it's like, okay, like what retailers are you working with? And as we've grown, we've worked with almost every retailer. So it also makes the system a lot easier of, okay, you're with Costco. Here's like the 3 forms we need to fill out and the website link for the specific portal, because everyone has a different process. You don't really guess like whose portal looks like it's from 1992 versus like, 2026. It's like crazy how dated some of these are.
I think that's a lot of retailers just generally, isn't it, in terms of their portals and their systems are very archaic. But it sounds like, so it's definitely a conversation around sort of your liquidity, cash coming in, cash coming out. That makes sense. So that sort of establishes the first layer of risk, what risk is here. And then second layer is, what retailer or what customer are you potentially working with as a brand, which then will either add or subtract on some of that risk. So if it's a Walmart, that might be looked upon as something more solid versus that random distributor in a regional area. Is that right?
Exactly. And then also like the history on both sides. Like, is this, your first time launching into Target or Walmart, or do you have an ongoing relationship? Because especially with the new launches, as you guys know, right, you have like slotting fees and you'll be doing all this extra marketing spend, and this $100,000 PO, you get paid out $20,000 on the first one because all the deductions are coming out of that. And it's like the next series behind it where you're properly paid back on it. And so that does factor in a bit as well. And then, we're looking at POs. I think one thing that we do differently, which we've seen success with, is even financing off of like buyer rewards or demand plans. And so if we have the emails from the email from the retailer has to be very clear on like, you're launching at 100 stores, 200 units a store. We're buying it from you for $10 a unit. And like, here's the date, and we can calculate the numbers out. If it's just like, oh, congrats, you're in Sprouts Forager program, like that we can't do anything with. But we did take the leap that, if you wait for a PO, that's too late. Like it's coming 2 weeks before it's getting delivered. That for these larger retailers, like you can basically call these emails or demand plans, the PO, and then take it there. And then because with the POs, we are financing inventory, right? We're not just giving it to the company, we're paying their suppliers. In the event that it did kind of fall through there, we have paid for new inventory that they can hopefully sell somewhere else, right? And so there is still a fallback in the event that like, all right, maybe they end up canceling, part of this order, which I can't say I've really seen, but like hypothetically, if we run into those issues, like at least we have new inventory that'd be sold to other retailers or D2C.
Interesting, because that was going to be my next question, which you touched on a little bit, was around sort of the timings of how this work, and I think it's an interesting one sometimes with retail where you may not even have decisions fully firm before you actually have to go into production as a brand based on your lead times before launch. And particularly these days, I feel like, and it'd be interesting to get your thoughts, but I feel like retailers are really pushing out their decision making in terms of when they actually confirm with a brand. I know we've been in, I think we did something like 18 range reviews with Morning Maid through November last year in the US and in a couple of other markets, and we're just starting to get sort of confirmation of some of those outcomes from those range reviews around now, which were realistically meant to be be provided around mid-January. So we're already sort of, call it a month, 5 weeks later, which then impacts those lead times to then, make a decision to produce and then be able to make the in-store dates. In terms of, so using us as, I guess, a live example, I'd love to really walk through, how would a brand engage with Spring Cash, and at what times would you need what information to successfully sort of work together? So we've recently just been accepted into Walmart for 4 additional SKUs on top of our 2 that are already there. So we've got 4 new items going into Walmart in August this year, and our lead times are roughly sort of call it 3 months before we say need to produce, and into DC probably 2 weeks to 4 weeks before that launch. We haven't had confirmation of store counts of those new items yet, and that's still to come, and it hasn't really been provided on a clear timeline of when that will be received. So say we've been received an email saying we're successful. What do we do now, and how do we work with you and Spring Cash?
Yeah. So what I always recommend, for brands in your situation is like, apply now, because then you connect your bank accounts, you connect the financials. I mean, honestly, that's kind of it. You enter some basic KYB info like address, business name, EIN, founder info, so we could do the KYC there. And the application itself takes around like 10 minutes because it's all just API driven and just collecting that data. And then at that point, we'll get this risk rating score, right? That's like mostly automated. I'll go in and check on the back end and make sure everything calculated correctly. And then we can kind of position to you like, hey, you guys are coming out like in our B tier, which means your fee on the PO finance might be 1.4%, or let's make it easier number, 1.5% a month. And so when you guys get that SKU count from Walmart, like, let us know, and then you'll need your vendor bills at the ready, which you can upload. This is actually a feature as of like 2 weeks ago. Like you can upload the bills. It used to be you'd send the bills to us and we pay them, which we hated for a lot of reasons. Just like risk of typing a number wrong, it's manual. And now we have our own bill pay that you can upload the bill for these vendors, and then you confirm everything. And then, we just get an alert in the back end to hit approve, which I think is much happier for everyone all around. And so then that way, once you get that SKU count from Walmart, you already know you're approved. There's no more like underwriting that has to be done. And then you just kind of submit, send over those, demand plan buyer award, and then we'll give like the thumbs up, and you'll have to send like a notice of assignment is called to Walmart, which says, hey, Walmart, we're now working with SpringCast to factor our receivables. Can you please update the payment address of this? And then, Walmart has a couple extra forms, of course, along the way in the process. But that's for it too. By starting the conversation earlier, you can kind of have these forms already like made and dialed in. And then, we have plenty of people who do that. And then they send an email. I actually got an email earlier today from a brand that was like, hey, like we have this Sprouts launch coming up. We're ready to go. Like, what else do you need? That it just makes it a lot quicker process. It's already a pretty quick process, but can make it a little smoother and give a little more peace of mind because you're already like ready to go.
That makes sense. And then updating those details, say with a Walmart or a Sprouts, does that mean that every ongoing sort of payment from a retailer then goes through Spring Cash, or is that something that can be sort of allocated per? Because I assume this is very much used for, say, a new launch, for sort of building up that first PO amount and being able to sort of finance that to actually launch successfully. How does that look ongoing, sort of working with Spring Cash?
Yeah, so that's a very common question that we get. So you can't really, with all these retailers, you can't set up with them and be like, hey, like this payment's going to Spring, and then this payment's going to the brand, and this one's going to Spring. It just like doesn't, these payables departments aren't the fastest moving. It would just like never actually work. And so what we do, and this is part of the advantage of being very, fintech first and focus is, every brand we work with has their own account with us, like bank account, essentially. It's assigned to them, but not just that, but like they have a Walmart account, they have a Target account, they have however many. So when we get a payment from that retailer, we know it's exactly for them versus a traditional invoice factor. A lot of them have one central bank account. So when they get that money in, they're like, oh, is this Connor's like target payment? Is this Luke's target payment? Like the invoice number was cut off in the wire detail. And so then they can't actually send you your money for 3 to 5 days, if not, longer sometimes. But because everything is segregated by these bank accounts, when a brand does pay down to zero with us and we get paid, we just remit the funds same day, like back to you. So it doesn't interfere with your payment cycle at all. And we have actually a growing number of brands, which is, I'm CC'd on all these emails, and where I see it, it's like, hey, like we got $20,000 from Target today. Your balance with Spring is still zero, so we sent you 20,000. And it's just like, because it's same day, it doesn't create that friction. Where of course, if there's a delay, like then the brand's like, hey, we're done working with you, let's move over. But what's great about it is like brands are paid the same day if they don't have a balance, and then when they're ready to go, if they need more financing, there's no lag because often the longest part in our process is not the underwriting, it's the waiting for Target or Walmart to confirm the NOA is set up. And so if you're okay with leaving that in place, which if you're paid on the same day anyway, it doesn't really make a difference, right? It allows us to kind of keep going back to unit economics on brands like LTV, where it like helps to stick around a little longer.
Definitely. And so that means then essentially then it's always on as well. So then when you come back to the next PO or something that you need finance, then that relationships is already set up. It's already in place. It's much easier to then potentially finance an invoice or factor an invoice or finance a PO based on that. And then I'm assuming then every payment after that, there's no interest expense or expense coming off those invoices. That's the same day straight into the brand's bank account. Is that right?
That's right. Yeah. So there's no interest, there's no fee, there's no, I feel like if we were a traditional type lender doing this, there'd be some wire transfer fee tied to it. But like,
There's always a fee.
there's always a fee. So no, there's like Spring Cash is really founded on being like transparent and flexible. And like we have one fee. Yeah, it's the funding fee that we're giving you. There's no origination fee. There's no no transaction fee. There's no like minimum balance requirement. Like a lot of traditional factors would be like, okay, like right, we're not doing your Target at Walmart. Like even if you don't want to carry a balance, you actually do. You have a minimum balance of 200K, or you have to pay the interest equivalent to that every month. And we're like, that's not fair to you. Like it's kind of a legacy, I think, with most of these lenders of like very ops heavy stuff where like, I mean, obviously people nickel and dime you on charges because like they try to squeeze you. But I think a lot of these just came out of costs that were incurred in a business, but those were costs in a world that was created in like the 90s of early thousands. And then when you're doing things tech forward, it's like, oh, you actually don't, we're not being charged a fee for this. So like, why would we charge you a fee? Like it becomes like a holdover of a different era.
Makes sense. And outside of invoice factoring and PO financing, are there other finance type products that Spring Cash do offer? I think I saw something to do with sort of working capital. Are there other areas that you are sort of leaning into and building out as sort of that future pipeline of products for CPG brands?
Exactly. Yeah. So one of them is the working capital access product. Effectively, it's like an interest only line of credit that's meant to be supplemental towards the PO finance and invoice factoring. And so for us, like we view it as, brands always want extra working capital anyway. So if it's like, hey, like we'll give you, $100,000 today, you pay us $1,200 a month ongoing. You can keep it outstanding wherever. If you keep scaling, you can keep borrowing more. And then if you need extra, like it's always meant to be a small amount. So like if you got 100,000 on this working capital, like you're probably getting PO finance of 500,000, 800,000. Like it's kind of meant to be a tinier piece because it's obviously a much riskier financial product, right? Like here's this chunk of money, you don't need to pay us back, but it gives the brands a lot of flexibility, and it allows us to, like I mentioned earlier, the delay in getting set up is often these retailers waiting for the confirmation. And so if we're able to be like, hey, like we know we're still waiting for Walmart to confirm, but here's like this 100K, you can just pay us back whatever you want, then it keeps them, so start solving that cash need, which is why they came to us in the first place, right? And then the second product, new product that we're launching is a card product just focused only on digital ad spend, which for a lot of CPG brands is not a lot, right? Because most of the ad spend is going to trade marketing, but we are working with a number of omni-channel customers, or depending on like, right, the specific CPG product offer, and they are doing a decent amount of Meta and Google ads. So we see that as kind of a nice supplemental add-on to like, if you're coming to us for this other financing, we'll give you this card that'll give you, the 30 or 60 days float. So kind of match a lot of what we're seeing out there. But hopefully the idea with it is that we're giving a little bit more aggressive credit limits because we're tying it into the PO finance and invoice factoring. And, we can have your balance fluctuate a bit based on like the AR receiving from those retailers.
Very cool. All important pieces. And I think, like you said, they feed into each other, and it guess, increases, I guess, I call it the average order value of each client, and you're actually becoming more useful and kind of, I guess, helping to fund their growth, right? So then they get those more POs, and it's kind of, it's a bit of an ecosystem you're building out. Is that fair to say?
Yeah, I think that's a good way to put it. Like, increase that cart value, increase the AOV, because, we meet brands who, right, like they're like, I actually just need, I was on the phone with a company earlier, like they're all D2C. They need a card with float. And they're like, yeah, we probably will get into retail eventually, but like, I don't know when that is. But, if we give them this card because we like them, they look really good, and then that retail shows up a year from now, right? Then we can actually take advantage of it. So yeah, it allows us to just say yes to more people, which I think you think about like lending versus investing, where yeah, I don't want to talk about like the investing side where, and especially at business school, I feel like people were always like, oh, I want to be an investor and VC is really cool and or PE. But one thing that I think people don't realize about the investing world is you say no a lot. Like you build hopes and dreams, you build these relationships out, especially on the VC side, where like you meet these founders, you cultivate this relationship, and then you take it to your investment committee if you're lucky. And that investment committee says no to like 99% of the companies they see. And you just go say no to this founder. And it's like, even though, right, you obviously as like the venture scout doing it for the VC fund, like think they're great, versus on like the lending side, what I actually like about it a lot more is that you can say yes to a lot more people and support that growth.
Especially the way that you've structured the company, right? Like it's actually you're position the company in the way that you can say yes to smaller brands and say yes to more people, and then through coming out with these additional options or kind of different structures, it's not necessarily one size fits all. It's like, okay, cool, how can we help you the best that we can right now, and kind of put them in a vehicle that will get them on, whether it is on shelves at a later date or onto more shelves through this kind of the card-based spending that they can just start pumping those meta ads, which I know buyers always love to see.
Yeah, well, then it's like great. You're getting depending on how good those ads are, right? You're helping advertise in the store very well to get those tours. And I think the other thing too on the investing side is that it also like we've seen a lot of success through like part of like my meetings with all these consumer investors is like they really don't want the dilution on these brands. And so like that gets a bad rap because people think of like predatory lenders. It's that's one of the reasons we try to be like as transparent as possible on only having one fee, on making things quick and easy, because like and I am biased as like a banker and a lender all my career, that like that is not a bad thing. But I still have student loans from I didn't graduate from Wharton. I still have my 3 semesters of loans, but it's at 2.6% interest rate and it'll be paid off like next year. But like, why would I pay that off? Like I could pay it off, but I could instead be putting this money in almost anything, a savings account, and get a better return. Where bad debt is obviously like bad, right? If you're paying 30, 40, 50% to run the business, but if you're able to find like a good growth partner where like the cost makes sense for what it's doing, then it makes sense to like, take debt all day. Where my mom was asking me like, you're gonna pay off your student loan early. And I'm like, why? Like, and it's like, why raise equity if you can get PO finance for this Costco order? Cause then you're diluting yourself, right? As a founder. And so I think there's a bit of like but especially maybe these early brands, like I try to be a bit of like well, hopefully they go with Springcast, but even if we're not the best fit, be sort of like a strategic debt advisor, because it's really easy to get led down the wrong path. And like I can understand these term sheets and these credit agreements, where I've always helped them compare and look at different offers, because other lenders I think really do try to make it as confusing as possible. Like I met a brand last year who, our lowest rate that we do is 1% a month, so like 12% APR. And she was like, oh, like, well, I'd love to work with you guys, but like my current PO finance and invoice factor is at 8%. I was like, I don't think that's true. Like if it is, great. Like we're not going to beat that, but like we basically borrow at that same rate. So I guess as the lender from our bank, but let me take a look at the term sheet. And if it is, like, you should go with that, but I'll make sure you're not, missing something. And then I looked at it, and this is kind of where traditional invoice factors are especially very sneaky, is, it said 8% on the funded amount of the invoice, right? So like if I buy $100 invoice from you, I'm probably doing an advance rate of 80%. So I'm giving you $80 now, and then I'll pay the difference later because of deductions. We'll see what the deductions come out at. And so this particular lender was charging 8% equivalent on this 80% funded amount, but then another 1% per month on the total invoice value. So $100, and they're only giving you 80, and they're charging this extra 1% there. So the 8 plus 12 is now 20. Then they had some origination fee baked in at like 1%, 1.5. So the true cost of capital is 21 or 22. And this founder who had never, this was early stage like company, had never dealt with business debt before. They're paying 8%, but it was really 22, and that's like it happens all the time. And so there's a huge educational piece that everyone here at Springcast does, but like where it's like we're double checking these terms that people think they have, like because even love Wayflyer was a great part of my like foundational university fintech e-com experience. But the way their MCAs and all MCAs are really structured is, they're telling you fee is 1% a month, but it's 1% a month on the dollar you borrowed, $100,000 you borrowed today, and you pay that same fee every month for the next 6 months. But you don't have $100,000 borrowed for 6 months. You have like $50,000 borrowed on average across the six. So you're really paying like 2% a month because you borrowed 50,000 and paid 1% of 100K every month. It's just kind of hidden in the math, right? Because it's not always like super intuitive that like with an MCA and principal amortization, you have to double it. And so we're always, there's a lot of education like that, especially combined with the invoice factoring, where I'd say question number one we get is, do I really have to tell the retailer? Are they gonna like care? Are they gonna like be worried about me? And I can understand why that could be a concern, but like these retailers have, I think one of them I spoke with said 20 to 30% of the companies they work, their vendors have factors in place. Like it's just a part of doing business. And I always think from their point of view, they know if there's a factor in place helping you, giving you money, that means you're probably more likely to fulfill your inventory and not like hit them with the last minute cancellation, which they're more worried about. It really frustrates me when I meet a brand and I want to bring them in the store and then they come back to me, they're like, I don't have the money to fund this. So like we're actually, I used to think of net, net positive to them, because like great, now these brands who would tell them no, that they were so excited to bring in, can actually come in because they have somebody paying for the inventory. Because raising equity is very, it's very hard.
I think that's a very interesting point in terms of the educational piece typically, and sort of the transparency that you speak to. Because I mean, if we look at it more generally, and a lot of the founders that I've met, and you've met thousands, not typically they're not finance people, or they don't come from finance backgrounds. So I assume that sort of education piece is really, really crucial on showing your sort of benefit versus, some of these other lenders and some of these other more less transparent lenders that, maybe structure things in different ways and then tack on a fee there and tack on a fee here. So it works out from being X% to, the total cost of funding is actually X, which I think is quite interesting. But just touching on the VC angle, and this is more out of my curiosity, but do you see that forming part of maybe the future direction of Spring Cash? I mean, you meet with thousands of founders, throughout, every month or every year. You help them get, essentially assist with their growth and get to understand what a good business looks like by helping them fund, that growth through debt. Does that then become a natural next step in terms of potentially taking positions in these companies?
It is one that would make sense, I think, because you do have access to a lot of, data and performance history from, the Spring Cash side. I think, we are a fintech, and it's not like a fund where if we were operating as like a pure fund, you could have a bolt-on kind of venture capital arm. I think, we're going to go through like a Series A fundraise later this year that, from raising from our own, we're a family office back now, but the next round of capital will be from VCs. That it would kind of add confusion if they were not trying to, as a VC, invest in another VC and go against their ethos. So no plan on that end, but we have talked internally sometimes about like a team syndicate per se, if there's like a company we like and everyone throw again. But I do myself a decent number of angel investments, and so if there are companies I see coming through that fit what I'm looking for in a brand, after we kind of do the Spring Cash underwriting process, because it's it also has by design, I can't thumbprint like a underwrite anyway, so like it is a very like segmented thing. But like if I see a company that's great that's come through, I will write like kind of a check in after the fact if they'll take me.
Totally. It makes sense with a whole pipeline of brands coming through and you having that visibility. So I think that makes a lot of sense. And I guess it transitions nicely to talking a bit about that angel investing side. And I'd love to know how you sort of got into that. And you mentioned it before, what is a good fit? And it sort of speaks to, I guess, what criteria do you sort of look to for brands to say, yep, that looks like an investable brand?
Yeah, so I think what we'll see how this plans out in my, if really 5 to 7 years to like see how my numbers play. But my theory is that, being, debt focused and still debt focused, I kind of approach these investments in a different way, where it is like very numbers driven, where like a pre-revenue brand is very like not going to be something I want to touch, because I don't know, are customers buying, or are they getting in doors? What's the velocity in those doors? If you're D2C, what is your LTV? Like, what is your CAC? And like, what's your operational history? Because I've seen, so many $1 million revenue beverage brands that some of them have a million of COGS, basically, a million of marketing spend, a million of payroll, and somehow they're losing $2 million and a million of revenue. And then others that are, million revenue, but like basically no marketing, 30% gross profit margin, and then no OpEx where there's only slightly loss making. Where if you're just looking at, if you don't really look at the financials, you kind of end up investing in a bit of like a money pit. And there's a lot of like money pits in the industry. And I think sometimes you see that investors don't really realize, if they're especially if they're from tech or real estate, it's an outside piece, that that's not, you don't have to be spending all this money on marketing or payroll. Like I've worked with multiple companies that are two people, hitting like 8 figures in revenue, that you can scale efficiently and scale smartly and have the right fractional help around you. So I'm really focused on kind of that like gross margin unit economic profile of like, for the D2C, CAC versus LTV versus AOV, the gross profit margin, and then velocity, what new doors are being added, and then just like your operational efficiency. And then the other ones I feel like are a little more standard in the terms of like what a lot of investors want to see, right? Which is like, is it a great management team in place and good founders? Are you kind of solving like a niche in the market that someone else is missing, right? Like, you making another protein water or ready to drink coffee? Like, is there something truly different? Where in the case of like Springcast's first customer, and one of my angel investments, Laurel's Coffee, like she is a ready to drink coffee, but what was really different is that like she's A2 milk, and a lot of people are lactose intolerant these days, but like they still want to have milk, and like they don't want to have oat milk, and they don't want to have banana milk or all these other things that aren't really milk in my they're like juices basically. Uh that like it kind of opened up like a whole new market lane, and it tasted really good. And what importantly also set it off for me was seeing like that she was launching in these new doors. Like, I invested, I guess June, July of last year, right before her nationwide Whole Foods launch. And when I looked at her financials, like incredibly lean operation, like her and her fractional COO. And this is all things I love to see, to the point that I shared it with one of my, couple of my former Wayflyer colleagues, and they saw those numbers too, and were like instantly in and invested as well. I do keep in mind some prudent advice I got from my restaurant banking days, because our largest by far counterparty was Taco Bell. We had like $300 million across a bunch of different franchisees. And I don't like Taco Bell. I'd rather get some like real Mexican food. But one of my managing directors was like, "Will, like your taste is not the average American's taste across anything, really. Like, just because you don't want to eat at Taco Bell doesn't mean it's like not by far the best performing restaurant in our portfolio." Uh, which was the case almost the entire time I was in restaurants. And so I do keep that in mind, when I'm like a company where like I'm not gonna eat every. I invested in like a women's shoe company that now they have a men's shoe, so like I can take advantage now. But like, I was like, I'm not the customer, but I spoke to a bunch of women who were fans. My sister-in-law bought a pair. Where I try to keep a bit of an open mind that like that's where the numbers don't lie, right? Like, you see that LTV, you see the velocity, that like if anything, if you think the product tastes good, it should almost have nothing to do with whether you invest. Because I think that's how people make bad investments. They just like love the product and they love the founder, but doesn't really care if I love the product. I'm not going to buy millions of dollars of it and make it an exit, right? Like, do the customers love it? And so yeah, I think that kind of, for me, yeah, good unit economics, good like overall kind of OpEx financial performance, management team, product, and is there like, are they nailing a niche that helps them like differentiate themselves a bit in the space? Because there are some very crowded areas in CPG.
Yeah. No, I see that for sure. And it sounds like a strong foundation. Look, Will, I know you kind of need to run, but last question. I mean, are you actively investing, or is it kind of when it just pops up through kind of Spring Cash? Can we send anyone your way, or is it kind of just something that's a little bit more passive, and when it's right, it's right?
I'm actively investing. Like, I will say though, it's like active and passive at the same time. Where like I'm not like have capital to deploy, but I'm not out here like calling it in. It's like, does it come across? So sometimes it comes across via Springcast. Sometimes I'm a member of the Angel Group. I'm a member of First Look VC, which are both really interesting ways to see deal flow. Angel Group founders invested in Siete and Poppy. And Bacot, so they got a great track record of exits. First Look VC is actually a really fun subscription box where Brian runs a Series A, Series B fund, First Look, but he helps seed brands invest and sends a box to 200 to 250 angel investors. And so you get to try out all this product and see the pitch. And then, even if you're not like, every month you try out 6 to 8 new products, kind of see the pitch, and it's like 100, I think $20, $140 a month, where sometimes you get the box and you're like, try some stuff and you just end up finding a new product you like to buy. Other times you find like an investment opportunity. So always happy to be sent ones. And then I think, where I do also help a lot of these brands is like, I unfortunately do not have infinite checkbook behind me, but I know a lot of other investors. And so if I see something that's like not a fit for me, I'm always happy to send it on. And then I've seen plenty of brands raise a lot more money from a lot more deeper pocketed people that like I just, sent them on the ones I thought would be a good fit. It all works out. So always happy to take a look and give my feedback that I can. I think that's as a founder, the more people you meet and thoughts you get on what you're doing, that's how you like build a track record for success and just being open minded. Especially like now, right? I'm this founder seat. Like I'm always like asking people who are applying, I'm like, give me feedback on like how we can improve the process better, this and that. And I think it's always really helpful. Like you get 50 pieces of feedback, 10 pieces of those feedback is probably wrong, right? But maybe the other 41 helps you get a consensus on what you're looking for. And but you don't know that unless you speak to 50 people. If you speak to just two and you get some outlier opinions, that might not be helpful at all because you just happen to speak to the two outliers first and not like the consensus vote.
Yeah, all right. No, I completely agree with that, Will. And I think, it is important to, I guess, gather as much market data as you can. And the same thing goes for like, I don't know, I see these brands in the supermarkets handing out free samples. And if you're asking me on the spot and giving me free shit, of course I'm going to say it's good. So it's kind of like you need to play the field a little bit more and kind of chat to some people within your target demographic and far outside to kind of, I guess, see where that truth is, because it's often sitting in the middle of kind of any feedback that you get. But look, I appreciate you need to run, Will. Thank you for coming on. And I think there's a lot of value in here for brands about how to navigate funding and the different options available.
No, thanks for having me, guys. Luke, it's great to meet you. Connor, great to continue our dialogues and conversations, and hope this is a useful conversation for anyone listening. And happy to just like keep supporting brands and trying out new products. I guess the best, and you guys, I'm sure agree, the best part about the space is just like
Yep.
you're always meeting great people and trying something new.
No, thank you very much, Will. Appreciate it.
Cheers.
Thanks, guys.